Do you think we will see 2% inflation again anytime soon?
Gosh, until you put on the anytime soon, I was going to say absolutely yes.
Yes.
I'm happy
In
to
the
make
year
any
2100,
forecast.
I can confidently predict.
So probably not.
The Consumer Confidence Index had its biggest drop in more than 3 years in February. We're at a crossroads moment in the economy. Uncertainty is back. The outlook suddenly kind of seems murkier than it has in a while. But is perception reality? To talk about this, we're here with Seth Carpenter. He is Morgan Stanley's chief global economist. He was at the Federal Reserve and also worked in the Obama administration. Seth, welcome.
Telis, it's great to be here. Thanks for having me.
This is WSJ's Take on the Week, and this is Telis Demos. Let's get right into it. This coming week, we are getting another inflation reading. The Consumer Price Index, the CPI, have the recent relatively hot readings, I would say. Kind of now we're back at 3% year over year as of January. Does that tell us that inflation is still a problem?
So I don't think it tells us that. I think inflation is clearly still higher than, say, the Federal Reserve would like it to be. They have a target of 2% for the personal consumption expenditure measure of inflation, and there's lots of details there we can talk about different measures. But I think if we look at what's happened with inflation over the past 1, 2, 3, 4 years, we clearly had a surge in inflation across the board: food, energy, physical consumer goods, services. That's been trending down, and it's been trending down pretty convincingly from its peak. But we have hit a bit of a rough patch.
Yeah.
I would not take the recent couple of months worth of data as a signal that we're back into danger, that we're getting to a place where inflation will actually start to trend up. Rather, I think there have been lots of events where there have been disruptions here, disruptions there. We had fires, we've had hurricanes, we've had strikes. All of those can really disrupt things. And in addition, at a really nerdy technical level, the Bureau of Labor Statistics that pulls together these data, they do these adjustments to try to see what happens, because every year you start to see some price adjustments happen at the beginning of the year. They try to make adjustments to smooth those things out. And we know last year or the year before that, there were higher readings in the beginning of the year than happened for the rest of the year. And we think the same thing is going on now. So it's a real hodgepodge, a lot of noise. The bottom line, though, is inflation has been coming down. We think it's continuing to come down for now. As we get to the middle of the year, things might change, but I'm sure you're going to push me on that later.
Well, so maybe January is not the best time to take a snapshot of what's going on in inflation, in other words. But let's drill down into the hot topic, eggs, right? Like what is going on? What is going on with eggs? Tell us about inflation, because it seems like, given that there are things happening just in the market for eggs, maybe that's a case that inflation is sort of more transitory than it is underlying. Is that the right way to think about that?
We are seeing egg prices go up a lot. I know I see it when I go to the market to buy eggs. And we also know that there is avian flu outbreaks. We know that there are culling of various flocks of chickens. And when you get those sorts of supply disruptions, it should not be much of a surprise to an economist that the price will go up.
Less chickens equals less eggs equals higher prices. I mean,
exactly.
Just to put it basically.
Exactly. Yeah. Now, a lot of people will see the price of eggs because it turns out human beings notice things like food because they buy it on a regular basis, and it's something that you can't necessarily do without. You got to buy food. And so the perception of inflation tends to be very heavily influenced by these sorts of developments. The price of gasoline is another place because people who drive to work, I'm lucky to live in Manhattan. I only drive about once a week. But nevertheless, people who drive, they see the price of gas every time they fill up their tank. And so there are prices like food prices, eggs in this case, gasoline prices that economists, psychologists would call salient, which means it really captures your imagination. You notice those things.
Well, let's bring this back to investors. And I guess the lens that I want to look at that through is the Federal Reserve. The Fed obviously has sort of been on a bit of a pause at the moment, initially expected to lower rates this year, haven't done so thus yet. What could this next CPI reading do?
It's a great question. So I would say right now, listening to Chair Powell at the last press conference at the January meeting, listening to some of the other communication from Federal Reserve officials, they are inclined to lower interest rates some more if, and it's a really important if they can get comfortable that inflation is still trending down. Now, my view, my read of the data, our forecasts at Morgan Stanley are, yes, in fact, that's what's going on, and inflation is trending down. Lots of noise, lots of perception, lots of things going on, but on a underlying level, that trend is downward.
So this specific number, let's say that it comes in at 3.1% or something, but if you look through it and they can see what you're talking about, this kind of ultimate slowing and the kind of the bigger factors, you're saying that 3.1 might, even if it seems like inflation is accelerating, that might not change the direction.
So I think that's right. So if we think about the upcoming CPI print, first, economists like to say, let's look at CPI, let's look at inflation, but let's strip out food and energy.
Yeah.
It's not because economists don't understand how important food and energy prices are for people. In fact, that's what most people pay the most attention to. However, if you look at the data, if you look at the way the economy evolves, looking at so-called core, i.e. inflation without food and energy, you tend to get a better signal about where things are going. So that's one version of
And that's
how they're
focusing
gonna
on
look
things
through it.
like home prices, insurance, like other,
So that's about right. But what's interesting is it's not home prices per se.
the cost of home, renting. And
Exactly.
things like that.
And it all comes from measured rents. And remember, inflation is the change in prices. It's not the level of prices. And this is another place where I think egg-headed professional economists like me often talk past real people, right? Because we're talking about inflation. Inflation's coming down.
Right.
Everything's getting a lot
But
better.
prices are still rising.
But
and
prices
so that's
are-
what people are noticing maybe. Yeah,
Exactly.
yeah,
Not
yeah.
only are prices still rising, people still remember what the price of milk was from 2019, right? And we're well above that. And so I think there's a little bit of a disconnect, and it's probably largely the economist profession's fault that we're not clear. But the Fed is going to be thinking about inflation and asking, okay, with all the available information, does it look like the trend is down?
Yeah.
I think they're going to read the data as saying yes to that.
Okay.
And they'll probably lower their policy rate one more time this year.
Okay.
Probably in June, maybe in May.
Okay.
Not at the upcoming meeting in March.
The consumer sentiment readings recently seem to be telling us a similar story. Different president, same story. The vibe session. People don't necessarily feel great about the direction of the economy, even though, thus far at least, the underlying metrics haven't really changed dramatically. Why, are we still in a vibe session, would you say? And if so, why? What does that tell us that it just seems like that perception is relatively unshakable, even once we're making huge changes, policy-wise? People still feel the same way.
Yeah, I agree. I mean, I think there's a lot going on there. I do think the bout of inflation that we lived through was jarring. And I think for some people it was close to cataclysmic. The price of lots of stuff that people need to survive, food, gasoline, apartments, just went up a lot. And if you were one of the unlucky people whose wages didn't go up with them or didn't go up faster, at least for a while, then that was truly scarring. I think on top of that, even though we know on average across the whole economy, wages have gone up by more than prices have, I think a lot of people who started off before COVID working really hard and feeling like they deserved a bit better, if their wages finally went up, I think they could say, well, that's just making things where it should be, and yet prices are still too high. And so even though adjusted for for inflation, maybe your wages have gone up, I don't know that you're going to feel that much better about it. So I think that's important.
And why does it matter overall, though? Like how consumers feel? Why do we care about people's feelings in this situation, I guess?
Well, I think the tricky part is there is a belief that the better people feel about the economy, the more they will spend. And the tricky part there is if you are a nerd, a wonky guy who spends a lot of time doing statistical analysis, like I've been trained to, it's actually really hard to figure out a way that if you account for what I call fundamentals, so income in the economy, how much are people making overall, if you get wealth in the economy, if you get interest rates in the economy, job growth, if you get those real fundamentals, it's really hard to consistently see in the data that the measures we have, at least of consumer confidence, change things a lot. Consumer spending last year and the year before was actually very, very strong, despite the fact
that feeling,
people felt kind of wishy-washy.
We're going to take a break. More with Seth Carpenter in a bit. Well, let's talk about the feelings of another segment of people, and that's the bond market. And it seems like the feelings in the bond there's the vibes in the bond market aren't great either. Well,
Depends on which week you're
depending
talking.
on well, it depends on where you're sitting, right? So bonds have been treasuries, long-term treasuries have been rallying, meaning that bond yields are falling. Now, that's usually a signal that that the bond market is expecting the economy to slow, right? That is usually not good news. They rush to the safety of treasuries. They expect more rate cuts from the Fed, so they're buying bonds. What do you think it was telling us that bonds kind of really made a big move over the last week or so with yields lower? What's that telling us?
I think there are a lot of things going on at the same time. One, the fall in rates on net this year, in part should be put in the context of how high rates had got. So the 10-year Treasury yield had got up to about 4.8%.
Yeah.
And at that point, lots of people were asking, is 5 the next stop? Is 5.5% the next stop? Is 6% the next stop? Are we really getting to a point where things
This
are
was
going
like
high?
post-election, late last year.
And even
yields were really running up. Yeah.
Things were running up. They came off a bit. But even early this calendar year, we were up at 4.8%. And so in that context, I think there's been a change in perception. So after the election, I think there was a lot of view that fiscal policy was going to be a big reason perhaps to have interest rates go up.
Yeah.
But what we've heard very clearly from President Trump, from Secretary Bessent, is that their biggest priority is to make permanent the tax cuts from the Tax Cut and Job Act. Now, let's think about what that means. Make the existing tax cuts permanent. That means leaving the tax rate unchanged. And so the economist in me says, we're not changing the tax rate, so I don't see why not changing the tax rate is going to stimulate the economy. I think that was a bit of misperception that people are now starting to unwind. I think in addition, over the past couple of weeks, the nearer term that you focused on, we've seen lots of headlines from Washington about the Department of Government Efficiency, the elimination of federal jobs, the cutback on federal spending. So different people will have different valuations about, is that a good thing? Is that a bad thing?
Well, the Treasury market sometimes likes to see those things, right? Because ultimately these are obligations of the U.S. government, and so they see the U.S. government tightening its belt as sort of good for the fiscal outlook.
I think
right?
that so I think that's definitely part of it. So leaving completely aside, is this good or bad in some judgmental normative sense?
Well, I want to get back to that, and we'll from the stock market's point of view. So hold that thought for a second.
But what could it mean for the bond market? What could it mean for the economy? Well, less government spending, fewer people employed. There's just less spending in the economy.
Yeah.
And I think I can show arithmetically that if there's less spending in the economy, there will be less spending in the economy.
Right.
And so less spending in the economy is the same thing as saying the economy is going to slow down.
What does all that mean for what's going on, what the bond market is sort of thinking about? What does that mean for the stock market?
Yeah, absolutely. And again, I guess when I was saying is it good or bad and I wanted to leave it aside, I was thinking more philosophically. You know, different people have different views of what government should do. I think the equity market looks at policy coming out of Washington and asks, is headline growth going to be faster or slower?
Yeah.
Is profitability for individual sectors, individual companies, is that going to be higher or lower? And I think that's a reasonably useful screen. I think in that sense, there's a shared view with the bond market and the equity market that less spending in the economy overall is bad for headline growth, and that's got to be, as a result, a little bit worse for equities. Now, a lot of folks in equity markets are also saying, can we get longer-term interest rates to come down? Because in some sense, it's a competing asset with equities. Secretary Bessent talked about maybe focusing a little bit more on trying to bring longer-term interest rates down. I think the key here is, why are longer-term interest rates going down? Because if longer-term interest rates are going down and everything else stays rosy like it has been, then it's got to be good for the equity market. But if longer-term interest rates are coming down because growth is bad, it's hard to see that being on net a benefit. So I think that's a key differentiation.
So I want to drill down, though, into a slightly different area. And this is something that you and the team at Morgan Stanley has been writing about lately, and that's immigration. The Trump administration has a mass deportation plan, essentially. And you guys estimate that net immigration will slow from 2.7 million in 2024 to about 1 million a year, perhaps, and then all the way down to 500,000, maybe by 2026. We should note that this accounts for both legal and illegal immigration. And you've written, though, that this will all slow growth, boost inflation, and present a thornier choice for the Fed.
Yeah.
Why? Spell that out for us a little bit.
So I think one of the simple ways of illustrating this is, again, 2023, 2024, growth in the U.S. economy was faster than I think anybody would have said is sustainable in the long run. And yet at the same time, inflation was coming down. How is that possible? Well, one way that that's possible is that you're making available to the productive side of the economy more resources. That is to say, the supply side of the economy was growing so fast that you were enabling that fast growth while letting prices come down. So that's part of it. I think the other way to think about it, again, if I go back to the point in time when I was a professor, how much can an economy produce? How much an economy can produce is determined by the technology the economy has. That's sort of evolving AI. We can talk about that in a future podcast, but it's technology. It's the amount of capital in the economy, physical capital in the economy, machinery, tools, equipment, and then it's the labor supply. So those are the determinants of how much the economy can produce.
So those are the raw materials of any economy, right?
Exactly.
The people to do things, the technology to do it, the equipment to facilitate it.
And what we have seen with the surge in immigration that we saw was a huge increase in the available labor supply for the economy. We went from an economy that was sustainably sort of creating enough new jobs for about 110, 120,000 people to the point where the economy could comfortably absorb 200 to 250,000 jobs. So it's just that much more extra labor supplied to the economy, and that's just really important. That surge was unlikely to stay forever. We had already started to see some signs that was coming off, but now policy is being put in place to really try to clamp down. So exactly what happens with immigration is going to depend on lots and lots and lots of things. And so the numbers that we've written down, I guarantee you will be wrong. The only question is in which direction and by how much.
You know, it just seems like immigration is not getting the airtime in the economic discussion yet that tariffs and fiscal policy are. How closely do you think we should be paying attention to, you know, what's kind of bubbling in the background in immigration? Because that feels like something that might suddenly kind of hit the top of the agenda when we see, say, a job report or something that really drives home the point that there are fewer workers in the economy right now. Like, is that something that will really kind of pop as an issue, do you think?
Yeah, no, I think given the potential macroeconomic impact, it is perhaps the most underappreciated policy lever that markets need to think about. So think about what we experienced coming out of COVID. There were times when people were afraid to go back to work. There's so much we didn't know about COVID. And across the board, businesses are reporting labor shortages as a key problem. And we saw an inability of certain sectors of the economy to produce enough goods and services to satisfy their customers. One of my favorite examples is in the hospitality and leisure industry, hotels.
Sure.
Right? There were times when 20-story hotel would just have the top 10 floors closed off, and they just wouldn't be able to book those rooms because they didn't have sufficient workers to clean, to manage, to staff. That kind of restriction in available supply of services is, I think, what we're looking at relative to where we had been in 2023 and 2024. So you have to be able to consume less, and because there will be less available, whatever the level of demand is, prices are likely to be higher. And it's going to be not uniformly spread across the economy. Chances are it's going to be more in some of the services sector, hospitality and leisure, maybe some of the warehousing industries, agriculture for sure. But I think the basic mechanics of it are pretty clear.
If you're an investor, do you think that like those companies, like there are companies in those industries that you should be sort of really keying in on and listening to their earnings calls and looking at their upcoming reports for sort of more on-the-ground kind of readings on immigration?
For equities, this is going to be another part that'll be tricky because the stock market is not the economy, and the economy is not the stock market, but boy, do they have to play well with each other. I suspect, and I think it's borne out now already with some of the earnings reports, any challenges with labor availability is first going to hit smaller, independent, privately held corporations, and not initially the larger publicly traded ones. So if we're thinking about this purely through the lens of the S&P 500, that part of the economy is likely to feel this impact later. It's going to be more the part that's not publicly traded, where it's individual smaller companies that are employing, fewer workers at a time.
Yeah. We're going to take one last break, and then when we come back, we're going to finish our conversation with one more question for Seth Carpenter. We're back with Seth Carpenter from Morgan Stanley, and we have one last question. Seth, in 30 seconds or less, do you think we will see 2% inflation again anytime soon?
Gosh, until you put on the anytime soon, I was going to say absolutely yes.
Yes.
I'm happy
In
to
the
make
year
any
2100,
forecast.
I can confidently predict.
Probably not.
Okay.
I think, especially if we're measuring this on sort of like a 12-month change basis, 1 month to the next, if you take the monthly change and turn it into an annual number, sure, we're going to have a couple of those because the data, they just end up being a little bit noisy. But if we're right and we have more tariffs in the pipeline that are going to come along, that's going to at least temporarily push up inflation for a while. If we're right and immigration is going to be sufficiently restricted that it really does impinge on the labor supply, that's going to push up inflation for a while. And so we tend to make our formal, dot the I's, cross the T's, sharp penciled forecasts that go out through the end of 2026, so about 2 years. And I would not put a lot of money on the idea that we're going to get back to 2% inflation before the end of 2026.
Seth Carpenter, thank you so much for joining us. This has been great.
Great to be here. Thank you.
Yes, we're rolling. Let's do the Telis clap first, and now the Seth clap. Good? Good. We're ready to go.
I have a lower pitched clap than you do, apparently.
Yeah, I guess so. I'd never thought about that. Is that like, can you get like a fortune telling from that, based on the timbre of your clap, you're going to live a long and healthy life. Okay.